The broadcast is now starting. All attendees are in listen-only mode.
Okay, well, first I'd like to welcome you all to our client webinar series. Today's webinar is on loan modifications, understanding loan modifications. We're recording this webinar at our offices here in La Palma, California, ERA by America. My name is Dennis J. Lopez Sr. I'm an associate broker of ERA by America, and joining me is Jason Prather.
Hi, guys.
And Kevin Kelly. Jason Prather is an associate of mine with ERA, and Kevin Kelly is with Chicago Title. You there, Kevin?
I am. Thanks for having me.
Thanks for showing up, and thanks everybody else for attending the webinar. I think we will just get right into it. The one thing I would like to point out, if you have a question, you basically have to raise your hand. If you look at your little screen on the side, there's a question down at the bottom, a little thing where you can click on questions, and basically it'll raise your hand and let us know that there's questions coming in, and so we can get to them. Hopefully we'll cover most of them before we get to the Q&A, but should you have something before then, just click on the question tab. Okay, so I will just turn it over to you for the moment, Jason.
Okay, guys. Again, welcome to our webinar. I'm here with Dennis and Kevin. What we're talking about initially here today is going to be the loan modifications and how we reveal them into these, into more elementary terms, because believe me, they're quite complex. So we're going to give you guys the rundown here. Okay, so you can give me control.
You know what? Let me just hand that over to you.
Sure, perfect. Thank you.
Okay, you got it.
Okay, perfect. Okay, today we're going to be talking about Wachovia and Wells Fargo loans specifically. All the information does or is tailored to those loans, although they do apply to most Fannie Mae and Freddie Mac home loans in general. We're going to explain HAMP, HARP, and HAFA. That's a fancy way of saying home affordable. That's the HA in each of these. Then the modification program, the refinance program, and the foreclosure alternatives program. And then at the end of our session here, we'll be having a question and answer period. Perfect. It's not really letting me advance here, Dennis.
Okay, it went.
There we go. Okay, excellent. Okay, so the first of which that I want to touch on is actually the HARP program in the middle of your screen there. The HARP program is the refinance program that the government's put into place for homeowners. This works very similar to a traditional refinance program where you have to qualify. The only difference is this applies to loan-to-value ratios of 125%, meaning if your home is worth $400,000 and you owe $500,000, then you may be a candidate for this refinancing, but you have to prove income and as well as your other debt ratios, such as your credit cards and car payments. HAMP is what we're going to spend the majority of the time on today. That's the Home Affordable Modification Program. We're going to go about showing you how you can keep your home and what you can expect during that process. And the last bit is HAFA, which we'll touch on very briefly at the end.
Well, you know what, Chase? This is what people need to understand. One of the major points, major points in the loan modification program is once upon a time, the banks used to make a loan and then you paid the bank back. That's how simple it was. If you had any problems with it, if you needed, some kind of a loan workout or something, you just go sit down with someone at your bank and work it out. That was then. Now, if we fast forward to today, let's go ahead and grab that next slide, Chase, if you will.
Sure.
Okay, so if we fast forward to now, the bank makes a loan, and then to you, and then the bank sells that loan to investors. And so basically you're paying the investors back. So that, coziness between you and your bank, that doesn't exist anymore. And that loan can go through a series of investors at any point. So it's got really complicated as to who actually holds the note on the house and who's invested in it. there's
Just as a side thing, guys, statistically, from the numbers we see at the title companies, the average loan is sold a minimum of twice.
okay.
Just something to keep in mind.
Yeah, and it could be serviced by the same people, but
Exactly.
so
investor changes.
yeah, just the investor changes, which this next slide just shows you why it's got so complicated. So when you're trying to do a loan workout, or the new term is loan modification, because of how it changes hands with these investors, you have banking regulators that are overseeing all this, and the Federal Deposit Insurance Corporation, you have the Federal Reserve overlooking it, the non-bank financial regulators when they sell it, when they securitize it, what's known as securitize it, and then the Securities and Exchange Commission, as the SEC, they get involved with it. The Federal Housing Finance Agency takes a look at everything that goes on, all the paperwork that's filed, all the loans that are filled out, to make sure that they're all, conforming to their standards. Then you have the regulatory umbrella groups that basically they're regulators watching the regulators. And then you have the unregulated markets, the foreign exchange markets, the U.S. Treasury securities, you have hedge funds, over-the-counter derivatives. You have all these different entities now that are involved with that loan that you thought, I'm just applying to my bank to get a loan, I'm going to make payments on my house, but now it's really complicated. So why don't you start with the loan modification flow chart, Jason, so we can break it down and show them what really happens with a loan mod.
Absolutely. Well, now that you know how many players there are, and there are a lot, I mean, we only named most of them, not even all of them. You can see by this flow chart here, and you start in the upper left. So you, assuming you want to go forward with a modification, or if you're having trouble making your payments, you go directly to your bank, which is, the immediate box to the right. So when you go to your bank, they do what's called a pre-qualification process, and they determine whether or not you're even eligible to apply. Right, so if you can imagine that, and then prior to them sending it to the GSE loans, GSE stands for Government Sponsored Enterprise. That's Fannie Mae or Freddie Mac. There's a pre-eligibility test, and we're going to touch on these to make these a little bit easier for you guys. Here's a pre-eligibility test. You have to be the owner-occupant of a 1 to 4 unit home in order to qualify for this HAMP program. You have an unpaid principal balance that is equal to or less than 1 unit underneath $729,750,000. That's what your loan balance has to be, less than. 2 units you can see, 3 units you can see, 4 units you can see. Additionally, your first lien has to be originated prior to January 1st, 2009. A lot of times we get questions about secondary liens, and that's a whole other animal. So we're going to touch base on your first lien initially here. Your mortgage payments, they don't want to exceed, or they have to exceed 31% of your monthly gross income. That's gross income, not after taxes or after deductions or whatever else you have taken out of your paycheck. It's that gross amount, the absolute max that you make a month. Then it has to exceed 31% of that. And then the last part, and this is also an important part, is that you need to have a financial hardship, and it needs to be able to be documented. Some clients that we talk to are on medical leave, they're on disability, and so that is a genuine hardship. Loss of employment is another genuine hardship, but you have to prove these things. So assuming you qualify for those things in the pre-qualification at the bank level, so if you're with Wachovia, it goes into, you're at the Wachovia bank level, and then they're going to go ahead and pass it off to these GSEs, the Fannie Mae's and the Freddie Macs, and they're going to go through a whole separate qualification process, and that's called the waterfall process. And in fact, Dennis is very good at explaining it.
Okay, so after you've they've already tested you on your pre-eligibility, and now they've handed it over to the Fannie Mae Freddie Mac servicers. They're going to drop you through what's known as a waterfall process. There's 4 steps to this process. Now, what this is created, the waterfall process, it was designed to bring your payment to within 31% of your gross income. So let's say the average homeowner, you're a couple payments behind, and you're headed into foreclosure. Maybe you're in pre-foreclosure right now. So the first thing that they're going to do to try and fix your loan is they're going to add in the payments that you're behind into your loan. So that's known as capitalizing your arrears. So you owe a couple payments, they're going to add that on. So, for example, you have a $100,000 loan and you're $6,000 behind in payments. They're going to add that $6,000. Total loan amount's going to be $106,000 based on the interest rate you have now. Whatever that payment works out to be, if it's more than 31% of your gross income, well, you don't qualify for that portion of it. They're going to have to go to the next step. If you do qualify, they bring your payments up, add it in, and you're good to go, it's within 31% of your gross income, done. The loan bond's done, they add that in, and you move on. But if not, let's say it's still more than 31% of your income, then you move to the step 2 of the waterfall process. And so what they're going to do then is they're going to reduce your interest rate. Now, they do this 1/8 of a point at a time down to a floor of 2%. So at 1/8 of a point, say you're at 6% right now. So they're gonna run it through the computer 8% at a time, all the way down to 2%. So if at any point your payment reaches 31% of your gross income, you're good to go. They're going to kick it back out, put you over into the trial mod program. Actually, they'll put you to the next step, the NPV step. But if not, you're still over 31%. The third step of the waterfall process is they're going to extend the loan term. So they'll extend that loan term all the way up to a ceiling of 40 years, and they're going to do it 1 year at a time. So if you have a 30-year loan right now, at 31 years, amortize your loan over 31 years, does that bring you within 31% of your gross income? No, then try 32, 35, all the way to 40. And if at 40 years amortization, then they haven't brought your loan payment down to 31% of your gross income, then they would drop you down to the fourth or final step of the waterfall process, and that's forbear principal. Now, a lot of people confuse this with forgiveness of principal. They don't do that. They're not doing that. What they're doing, though, is so let's just say you have that $106,000, and they've added everything in. They've reduced your interest rate to 2%. It's now a 40-year loan, and you still don't qualify at the 31%. So let's say you need to get down to the $95,000 loan limit. That would be your loan amount, and then finally you fit into that 31% gross income. So what they would do is that $11,000 from the 95 to 106. What they're going to do is they're going to set that aside until you're not going to make any payments on it, and it's not going to be interest bearing. But what it will do is it'll just sit there silently until you either refinance, you sell the property, you do something else with the loan, and then it just comes right back into play. So it's not forgiven. It's still sitting there, but it's not taking it's not a part of what your payment is. So now, let's say after they forbear, they added in your arrears, they reduced your interest rate, extended your loan term, and now the $11,000 is put on hold until you do something else. So now we can move on. It got you to 31%, and now you'll move on to the next step in the process. If you, by the way, if you're looking at this flow chart, if you don't, after all that, if you still can't qualify, and normally that forbear principle, it's not set in stone because we don't know this yet, but it's about 20%. They'll they'll forbear about 20%. Once it gets past that, then you go to the right. Where you see in the flow chart, it's to the fail. But let's just say we did get you to that 31% through the waterfall process, and now you go to the pass side. And what that is going to do is put you into the next test. So we've had eligibility tests, a waterfall process that you've been through, and now they're going to run with the NPV, and that's known as the net present value. Now, if you, on the screen, you see that fancy formula. It looks like hieroglyphics. It's what they use to determine the net present value of the property. And basically, it compares the value of $1 today to the value of that same dollar in the future. it's a formula that it makes everything a moving target. So you know what? Basically, this is for the investor's best interests. Chase, why don't you tell them about that part of the loan mod process, the investor's best interests?
Absolutely, Dennis. Unfortunately for the homeowner in these situations when you're trying to get these modifications is the way the laws are designed, and this is by Governor Schwarzenegger here in California, but don't worry, he's not the only one. But if you look at this sheet here, you'll notice that mortgage lenders and servicers are authorized under their pooling and servicing agreements to modify mortgage loans when the modification is in the best interest of the investors.
You know what, Jason? Let me try and give you a highlighter here. Let me see if I can give you that. And make sure, okay, you still got the keyboard.
I got it. Yep, absolutely perfect. So, under specified circumstances, mortgage lenders and servicers are authorized to modify mortgage loans when modification is in the best interest of the investors. All right, so notice that doesn't say homeowners, that says investors. So, you're going through all the trouble of, you're doing the pre-qualification through your bank, saying, okay, here's all my documentation, you think I make it. They say yes, they pass you to the next step, which is the government-sponsored enterprises. They pass you through the waterfall process. If you make it through the waterfall process, then they pass you on to the net present value test. And then what the net present value test does is it determines whether it's in the best interest of the investors or not. So, like I said, Schwarzenegger wasn't the only one who instituted a civil code to that liking. The feds joined in just the same during the Hope for Homeowners Act. And you'll notice on this page, here's the language. Any investment contract between a servicer of pooled residential mortgages and an investor shall be deemed to act in the best interests of all such investors. So again, it's there. Unfortunately for the homeowner, is whether or not you deserve to have a modification or not, it's really not up to that. It's really as to whether or not the investors are going to make more money or less money by them modifying your loan.
Oh, you know what? Here, what we're looking at right here, Chase, is the actual calculation that they use to determine if it's in the best interest of the investor or not. And it's a little blurry here, but basically you have three columns. And basically the first column at the top where it says as is, this is basically what you're looking at. The loan just stays exactly the way it is. Then loan 2 under the top scenario is, column 2 is the modification column, and it's what the loan will look like, and you're looking at the bottom line there if they do a loan modification. And then the third column, loan default liquidation, this is what they'd be looking at if they just foreclosed and sold the property now. Basically what this chart tells you, what you need to look at it for is if they do the loan modification, lower the interest rate, and accept payments over a set period of time, during the end of that period, is the investor going to be better off? Are they going to make more money letting you continue to make your payments? Or if over that set period of time they would have been better off just cutting their losses, foreclosing right now, and getting their investment dollars back where they can go reinvest somewhere else. So nowhere in this form does it say best interest of the borrower or anything. And this is not because this is put together this way because it will go back all the way. We don't have to go look at the slide, but all those financial regulators, everything has to be legal and up to snuff, up to par with all the other financial regulators. The NPV, it establishes fairly objectively, there's some key language for you, whether it makes sense to mod or foreclose. Why don't you tell them about this, Chase?
Sure, Dennis. Again, the NPV test it's coupled here with the affordability test. So the MPV, as Dennis said, is really just a test for the investors, and how the investors make an educated decision or an objective decision is, in part coupled with this affordability test, and that's what's called DTI, or debt to income. And the debt to income ratio, we mentioned it sooner, has to be 31%, and then your total debt to income ratio, including your car payments and your credit card bills, all that, cannot exceed 55%.
Well, you know what, Chase? Let me just add, at the 55%, if your DTI, your debt to income ratio, if it's over 55, then you have to go to mandatory credit counseling, mandatory credit consolidation counseling, and so on. And if you don't attend these mandatory meetings with these people, you're kicked out. Your loan mod is kicked out.
And so for a visual of what that is when it's kicked out is, you would go from the net present value, or the NPV test here, over to the right to this category, which is a fail, which is a modification fail. You fail to qualify for your modification. Dennis, I think
Well,
we kind of touched base on that in terms of, from a homeowner's perspective, is what are your chances of making it past this NPV test right here? And we brought you some numbers for that, just the same.
Well, you know what? If you go back to that, the flow chart one quick time, because I just want to recap for them. So far up there it says GSE loans. You've had to pass the eligibility test here, and then you've gone through the waterfall process, and you had to pass that. Then it was run through the net present value process, and you had to pass that. After doing all of that, now you're still not home free, because now you have to begin a 90-day trial. The 90-day trial doesn't mean you get the loan mod. You have to, if they allow you to make a 90-day trial, you have to make your payments. You have to live up to some reporting requirements that they will then use in the NPV equations and so on. And so we've gone all this way, and we've done all this, and we're not in a loan mod yet. So go ahead, Chase. Take it from there. I just wanted to recap.
Yeah, so what are your real chances? Here's an example of how many modification requests went through. I mean, not only modification requests, but just requests for financial information, saying the borrower contacted the bank, and the bank responded to them saying, we want to see your financial information. Dennis, do you want to?
Yeah, well, if you look at this, the number of trial period plan offers extended to borrowers, they're showing 757,000, which is 31%. But that's the number of requests. This is the number of requests for the people who have made it past the eligibility process, and now they're starting to process the actual loan modification. This doesn't show the actual number of people that got kicked out before that in the eligibility. We've got some numbers coming up later that will show you what those numbers look like. But they're
now, and these are national numbers, correct, gentlemen?
Yes, Kevin, exactly. This is not just
something to make sure that point is made. When most of the banks are looking at doing loan modifications in other parts of the country as opposed to Southern California, the disparity is much smaller because the sales prices are lower. We find that that statistically, Southern California particularly, but California in general, becomes even less of a percentage because, again, we're dealing with bigger numbers. We're dealing with over-encumbered properties to the tune of 200,000, not 20,000. So, again, that's national numbers, just to reiterate.
Excellent point, Kevin. Thanks for bringing that in. That's kind of blurry right there, Jason, isn't it?
It is. But what we're showing you here is just a complete list of the servicers who are part of this program, and we'll zoom in on some of these figures here, and then we'll kind of take an analysis of these lenders, and then you can match up your lender of choice with the ones that we show you. So, for example, some major ones here: Bank of America, Citi Mortgage, JP Morgan Chase is huge. So just, taking a look at the non-blurry version of this, here's some examples of the trial plans offers extended. Right? If you notice, it's 99,000 out of 796,000 that were eligible for this program. So trial plan shares offered at that point, 13%.
Yeah, that works out to 1 in 8. 1 in 8.
That's right. So about 1 in 8 homeowners who are eligible for this modification process, and by eligible we mean you've made it through the pre-qualification test with your bank, you've made it through the waterfall process, and you've made it past the net present value test. So now you're finally to the point where they may extend you a trial offer, and if they extend it to you, only 13% are actually getting to that point, right? And if you look a little bit farther down the line, is the ones that are actually start, it's even less than that, because the terms that they are offering are typically not going to help the homeowner stay in the house. So those that are actually helping the homeowner stay in the house, it's 27,000 out of 800,000 basically. So
you know what, Jason, if I could interrupt you for a second, I just want to, I have a client who went through this whole process. It was a lengthy process, drawn out, had to bring in all kinds of paperwork, went through it all the way to the end and got to the part where they offered her a loan modification. Her payment was at $3,100 a month. When they offered her the actual loan modification, it was going to drop her payment all the way down to $3,000 a month. So that's why the number at the right, the 4%, is less than the 13, because a lot of times what they actually come back and offer you in the loan modification, the trial mod, doesn't really help the situation.
Yeah. Typically that $100 discount is not going to make or break the difference as to whether or not the homeowner can afford it or not afford the home. So you're absolutely right, Dennis. Specifically speaking to our Wachovia and Wells Fargo clients here who've joined us, Wachovia Mortgage and Wells Fargo Bank. You'll notice Wachovia Mortgage, they don't have as many mortgages as JP Morgan, Chase, or Bank of America, but they still have 62,000 people eligible, right? And the trial plan's offered 3%. That's only offered. That's not even the ones where they decide to start it. If it's the ones who start it, it's 2%. So, they're typically not the type of bank who is going to give you favorable modification terms. They're just not going to do it. So here's Wells Fargo. They're better, but by any means, 12% is not a great opportunity to even have one extended to you. And then if the terms are there, 6%. So in terms of being a homeowner and really getting that opportunity to go through and start a modification and get to that point where you can keep your house, it's not very good, unfortunately.
You know what? Let me bring this point in, Chase. Is Wachovia Mortgage, which is now Wells Fargo Bank, but they bought a lot of the World Savings loans. The World Savings loans made a lot of these option type loans that are negative amortization, where you pick a payment, A, B, and C, and so on, and they not only gave them the pick a payment, but they started them off at these teaser rates, which are 1%, maybe 2%. So one of the reasons that you have less of these modifications that are being offered are kind of going back to what Kevin said. With these ridiculously low interest rates, people could buy a lot more house. So they were pushing the market up to the edge of the cliff to where it finally went over. So you have a lot of these loans that when Wachovia bought World Savings Bank, they inherited these loans. So these people are generally way more upside down than someone else who qualified at the standard rates and so on, that didn't have these option loans, that didn't have these teaser rates. So, they could afford to pay more because of the fact that their payment was so low. Now that their payment has gone up, they're so far underwater that when you run them through the NPV, the net present value, and the investor looks at that and he's going, okay, this is what we're going to end up getting and this is where we're at now, they don't pass that. So they get washed out in that portion of it, which it directly relates to the lower percentage rate of people that are taking or getting even offered.
Well, and to that as well, is another, World Savings had a hard money division as well, which is Golden West Financial. And those are in there as well. It's Golden West Financial, World Savings, Wells, and Wachovia. So the scenario you just ran through, Dennis, is even more disheartening if you wound up with Golden West Financial because you started with a hard money lender. So you were automatically upside down from day one. So kind of something to keep in mind.
Okay, it's an excellent point, Kevin. Your voice was fading out just a little bit there, but...
I'll speak up a little bit.
Thank you very much. It was...
no problem.
Just that last part about the disheartening from there on?
Just because Golden West Financial was... If World couldn't do it, they were referred to Golden West. Golden West's requirements were a little more lenient even than a World Savings situation. So if you started with a Golden West Financial loan, which does fall under Wachovia's umbrella, and Wells, you probably started out in almost 120% value position to begin with. And that was before we saw the prices drop to these levels. So you're it's a little disheartening if that's where you started.
Gotcha.
Just for those people that might apply to.
That makes sense. So you as a homeowner, you're probably asking yourself at this point, what do I do if I'm in, not in the 2% or the 6% that actually do get the modification? Right? And that's a very good question because probability says that you are going to be outside of that 2%. And so we're going to touch on that just a second here, which is the HAFA, which is Home Affordable Foreclosure Alternatives. And this is kind of the next step of our process. And in fact, we have Kevin here who is an expert in some of these processes.
Well, as we go into deed in lieu, there are a couple of variables that are the most important. And as you can see from the slide, you are giving up the property voluntarily. In most cases, obviously, the property is over-encumbered. So when you give the property up voluntarily, the lender does not automatically have to cancel your loan obligation and in its entirety. It is looked at by most lenders as, even though it was voluntary and you gave it up to someone else, the lender didn't okay that in all cases, so they call the loan for the total amount, which makes you personally responsible, i.e., let's say it's my house. Kevin Kelly would be responsible for a $600,000 loan on a house that I may have sold to someone in a deed in lieu of foreclosure for $400,000. Therefore, we get to point 3, which is lender may or may not agree to forgive the deficiency. In the scenario I just ran through, that's $200,000. If they do not forgive that deficiency to me, it becomes a tax liability for me. And so as you go into these, I would caution people very, very strongly, and certainly to do it through the other individuals on the phone. If they can certainly walk you through it, I can certainly walk you through it. But everything in writing from your lender, from if they're going to issue a deficiency judgment, is there going to be a tax liability to me? Am I going to be responsible for the total loan amount, or simply what we sold the house with a deed in lieu, that value, and the rest is going to be forgiven? How is it going to be reported to credit agencies? These are all questions that are very, very important that you get from those individuals in writing, because these are the things that kind of wind up not only just to give your house away, but then you wound up with a tax bill, and that's not good.
You know what, Kevin? What you're doing is you're giving away some of the goodies that we're going to be offering in our next webinar on short sales. You know what? Hey, it was a very good preview, but if you could, Chase, if you would punch back up slide 20, if you can go back to that for a second, and I'll show you how Kevin got to what he's saying. And, we're just trying to get you the information. We're trying to give you the facts to where you guys can you have all the information, you know what your options are, so that you can actually take the next step in taking care of your entire situation. what we're trying to do is be as straightforward as we can. We're not pulling any punches. We're showing you the numbers, how it actually comes, we're getting them, from the Department of Treasury. These are numbers that are coming from HAMP, the Home Affordable website, Making Home Affordable website. These are numbers that are real, that are out there, that I don't know why that you guys aren't being told this stuff straight from the get-go. So where Kevin was taking us was over to the right, where we're looking at this loan mod flow chart, over to the fail portion. So how we got there, though, was we started with you went to your bank, you filled out some forms. Those forms then, if you passed that pre-eligibility thing, then they got sent to Fannie or Freddie. Then they'd put you through the waterfall process. If you passed that, then we're just saying that you did. And then you got dropped into the net present value process, where they had to determine if it's good for the investors to give you a loan modification. And then they put you in the 90-day trial period for the loan modification. And let's say that you even got into that, and then you missed a payment. See, if you can do exactly what they say for the next 90 days, then you will probably get your loan modification. But as we see the numbers, the way they're actually panning out, that's not happening all that often. You guys need to know that. So a lot of people, and when I say a lot, we're looking at if 4% are getting through, that means 96% are not. So you're going over into the right-hand column of the unsuccessful loan modifications. Now, the next step, what's going to happen is the whole process, this whole loan modification, making home affordable thing is meant to start cleaning up everything. And so everything is going to start amping up, where they've held back on foreclosures before and pre-foreclosures. And shoot, I know of people who have been in their house for over a year and not making a payment, and the banks haven't moved on them yet. Well, as this thing starts to clear up, who's going to make their payments and who's not, you are going to start to see more of these failures. And so when you get over into the right-hand column, when you failed, and you're not going to get your loan modification, your payments are just, eating you up, eventually there's going to be a foreclosure. That's what we're going to go into on our next webinar, is what is the next step if you get to that process. But quickly here, there are some effects of the different ways that in the failure, and we're just going to go touch on them lightly here. If you go back one slide, Chase. So Kevin just talked about the deed in lieu, which we'll go into even more detail, Kevin, on our next webinar. And so these short sales, Kevin, quickly, what are you seeing in short sales now coming through Chicago Title Company?
The Wachovia actually ones have really been streamlined, and they have a very good system in place where you can actually, they're being very upfront. They're not issuing deficiency judgments. They're not asking for documentation on hardship. I mean, there's lots of variables, but that is not across the board. There are very specific lenders that are being very proactive with their existing lien holders. And those people, whether they've missed a payment, whether they haven't missed a payment, those are the types of people that they're reaching out to. Some lenders are totally not doing that at all, and it's kind of a crapshoot on as far as time and all of that. Short sales are almost always approved. We're closing 90% of them, but we're not closing them in a 45-day period. We're closing them closer to a 90-day period or a 120-day period.
Okay, and so we can go into the whole details of this on our next webinar when we have more time allocated to that specifically. And that is something, after you've learned the loan modification process, you really need to learn the next process, the next step of what happens. But Chase, what about the effect on credit of the deed in lieu and short sales and foreclosure?
Yeah, it's a very good question. Obviously, Kevin ran us through the deed in lieu process and even touched base on the short sale process. But really, why would we even consider those things? If we don't have the modification, then the next step is what? Well, if you want to protect your credit, and why would you want to protect your credit? Well, to ensure your financial stability in the future. I mean, you're really just protecting your prospects in the future. And that's only important if you plan on renting a house or getting a car or even taking out any sort of loan, credit card bills. Those things, it's going to impact you in the future. It may not today, but it will in 2 years from now when you try and buy your next car. Again, we're bringing you this information purely out of your own benefit so that you know your options. You can see what's available to you in the event that you find yourself in this situation. And a deed in lieu is certainly better than a foreclosure. A short sale is certainly better than a foreclosure. So almost anything is better than a foreclosure. And that's kind of where we'd like to start for you guys. So, specifically relating to HAMP, HARP, and HAFA, some of these immediate credit benefits I touched on are finding rental, seeking employment, cell phone, insurance, credit card rates. All of those things are impacted. We didn't really talk about seeking employment because a lot of employers do a credit check and they do background checks, and they will see that there's a foreclosure on your record, and that can be conveyed as irresponsible, knowing that there's other alternatives out there.
And something just as an adjunct that we're just seeing recently, and this is a very new phenomenon, where we're seeing it affecting, if it was a foreclosure, they're not approving student loans. Those are federally and state backed as well, but which doesn't affect people if it's a short sale or a deed in lieu or any of these other programs. So that's something that they've added in. They're figuring if you got your house foreclosed on, why should we educate your child? And that's a big deal, and especially depending on how old your children are and where they want to go to school.
Well, you know what, Kevin, that's such a great point as to why we're bringing this entire webinar series. It's a 6-part series, and what I have found, what I've seen out in the field talking to people, everyday people that have these type of loans, is that it's not just the loan where they're having the problem. It's just the modification in and of itself may not cure everything because everything starts to snowball on them. But you know what, I think, Chase, that you put together we have some slides here on what the new guidelines are for the credit on the existing as compared to new.
Mm-hmm. Because obviously you want to know the impact. Well, how does a deed in lieu compare to a short sale, and how does a short sale compare to a foreclosure? So here we have the current policies versus the old policies. So time period after a pre-foreclosure sale. This is actually applying to the short sale that we were talking about. Is the new requirements. There's a 2-year time period from the completion date before they will fund a new loan, before you can get a new loan here. No exceptions to that 2 years. It is 2 years, and then there going forward, you can begin reestablishing your credit. The next is deed in lieu of foreclosure. So, if we're going to prioritize these things, it would probably be in this order. Previously, it was a 4-year time frame from the date that you completed the deed in lieu of foreclosure. The new requirements here, it applies 4 years up to 7 years, depending on the completion date. So, while it's certainly promising, it's better than a foreclosure, it doesn't necessarily guarantee you the best option for you. You'll notice borrower may purchase a property secured by a principal residence, or second home or investment property within the greater of 10% minimum down payment. So that impacts the down payment amount that you're going to have to go forward with. And then foreclosure. Previously, it used to be 4 years. Now that's a little while back, but now what they've extended it to is now a 5-year time frame. And that's a best case scenario, 5 years before you can even be considered for another home loan that's insured by any of these Fannie Mae or Freddie Mac. And the 5 years is just before they'll consider it. Then you have to consider that you have 7 years. It could be up to 7 years depending on how severely your credit was impacted by it, how many months you waited to start your short sale or to issue your deed in lieu of foreclosure. So hopefully that'll give you a better idea of the process and the severity of each alternative here, each option.
I'm looking at this streamlined short sale, and it says why are banks offering streamlined short sales? says one aspect of Wachovia's current industry-leading campaign is to help troubled homeowners. Now, Chase, you just showed us earlier in this presentation that they're really not helping the troubled homeowners. They by law, they have to help the investors. Everything is based on the investors. But I think you'll agree with me, Kevin, what they're doing, what does help troubled homeowners, is they're allowing us to come in and represent you, licensed real estate brokerage, to come in and represent you, and they're working with us now. So that does help you out. Is that the way you see it, Kevin?
Exactly. They've streamlined it. They've made the bureaucracy and the paperwork much, much diminished from what it used to be. And Wachovia is kind of ahead of the game on this. And we're hoping that we see the major lenders follow suit, but that hasn't occurred yet. So right now what they're doing is they're taking away some of the impediments, as opposed to having to give them every document about your hardship for the last 2 years. You get to answer 6 questions over the phone. That expedites everything right there. There's things like that they put in place that has really expedited it. And we've been doing this since November, and it's gone very well.
Okay, then let me ask you this, Kevin, because, not everybody that's going to be watching this webinar have Wachovia or Wells Fargo or, the World Savings Golden West Loan.
Golden, right.
Through your title company, through what you're seeing, what about the other ones? What about Bank of America? Quickly, what about Chase? What about Citi?
Bank of America, we're averaging about 135 days to close a short sale from the opening of escrow. Chase has brought their number down from about 120 days to maybe 80. Again, we're seeing movement in the correct direction, but we're certainly not seeing it in 38 business days like we are with Wachovia. Does that answer your question?
That's perfect. That's
okay.
I hope it answers the questions of people that are going to be looking at this, because that's what we're trying to do.
Right.
Trying to answer their questions so that they have the honest truth, and then they know what is the next step that they need to take. Until they sit down with us, Kevin and Chase, until they sit down with us and we look at their situation specifically, exactly as it sits, all we can do is give them the information here and then allow them to try and apply it to their situation.
You're exactly right.
And so the obvious question there is, what's in it for us? What's in it for Dennis, Kevin, and myself being, realtors or title reps and things of that nature. But for us, is we understand that, we have to provide some value to you, and being a troubled homeowner, if you do find yourself in this position, you're going to want a resource where somebody's actually providing you with the facts and how it happens. And, we certainly hope that you see some value in that, and then we can build a client base around that. This whole next step webinar here this webinar series really about the modifications and the short sales is meant to make this as broken down and as easy and accessible to you as possible. So we know that if we provide those things, we're going to get referrals out of it. Even if you don't end up being a candidate for, a short sale, which is the optimum for us, we still know that if you know somebody that is, you're going to value what we provided to you here today. And, that's really the objective. So that's the honesty from our perspective to you guys. So, I think one of the things that got us in trouble was transparency with the real estate, debacle that happened. So, this is our way of correcting that.
And you know what, Jason? Let me just throw in there too that most of the people that are looking at this webinar, they're getting bombarded with a bunch of mailers every day. They're probably getting 2 or 3 all these loan modification companies, all these people that are they're the so-called short sale experts. They're getting completely bombarded, and all they're getting, and I've seen this mail. I've been in the homes of these people, and I've seen the mail that they're getting. And all they're doing is getting the standard, come on type of literature to try and get their business without these people really making any attempt to explain exactly how the process works. If they're saying loan modification, they just want $2,000 or $3,000. They want to extract that out of your wallet in order to do a loan modification for you. If it's a short sale thing, they're just going to go based on the assumption that we're just going to get out of here and we're going to take a listing and so on. What we're saying with this and what's in it for us is we're willing to sit down with you and go through the entire picture and see what is exactly in your best interest. And by doing this, then, like you said, Chase, we're going to earn their trust, and in the long run, we are going to end up with a lot more business. I've been doing this for 25 years now. How long have you been in business, Kevin?
I'm 26. I'm right with you.
Okay, well, you got in line before me then, And Chase, I know this business is in your blood, through Mark I Mortgage and ERA and so on, and we've been here for a long time, and we're gonna be here for a long time longer. So, can I go ahead and do the commercial on this, Chase, or do you want to do the commercial?
You got it, Dennis. Take it away.
All right, thanks. Okay, you just sat through, before we get to the Q&A session here, you just sat through the loan modification step of the Next Step Consumer Education Series. The next webinar that we're going to put out there for you is we're going to put it together and try and explain to you honestly and in a way that you can understand what short sales are. And in that, we're going to explain foreclosures, deed in lieu, and all the other things that are a result of I can't keep my house, so what do I do it? What do I do with it now? What's my next step? So the next one, go ahead to the next slide. We'll make this as painless as possible. We're going to put together some debt consolidation experts that you can sit down and ask some questions without having any fear of having to sign any contracts or anything. They'll be able to answer your questions regarding debt consolidation, and we will bring the best people in the business to you through the webinar. All you have to do is sit in front of your computer and you can find this. Credit restoration. When people go through this process and they get themselves, and believe me, you're not alone, not by a long shot in any of this. And a lot of people have problems with their credit and so on. A lot of times those problems with your credit can be taken care of if you're prudent and you do it in an effective manner. So what we want to do is bring in someone and discuss with everyone just how you get your credit restored, especially if you have to go through the short sale process. And then you do want to buy a home within 2 years. Refinancing. There's a lot of people out there that actually they're really not aware of the fact that they can refinance, or if they're thinking about refinancing, there's some people that have equity and maybe they don't think that they do. So what exactly is involved in refinancing now? Post-meltdown, what are the new rules and regulations? What can you do and what can't you do? And loan limits and so on, and who's making the loans. A lot of people want to know that. As we were going through all these loans and seeing all these people that got in trouble, one of the things that we did notice is that hardly anybody has living trusts. Even in the most affluent areas, we're seeing less than 30% of people that actually have their property in a living trust, which, when times get tough, can really protect you. So what we want to do, we're going to bring in some attorneys, at least one, who's an expert in this area, and explain to you what are the benefits of a living trust as it relates to your real estate picture, what are the costs of establishing a living trust and so on. And it's part of our entire consumer education series where we tie everything together. And we put it out there, and what we're trying to do is to earn your trust and show that there are people out there who will honestly explain the situation to you. We think that'll win your business. So now, if there's any questions out there, we'd be more than happy to answer them for you. Looks like we got about 5 minutes here, gentlemen. So, you know what, Chase? There's a question that I see here is, what does this cost? What does it if someone comes out and sits down to counsel them? What's it going to cost them?
Well, the beauty of it is our consultation is totally free, right? I mean, from the perspective of the homeowner, depending on the direction they want to go, the loan modification process through HAMP is free. It's something that started, it's initiated by the homeowner to their bank, and the bank takes them through the steps. If they have questions about the paperwork that's provided there, we can make ourselves available for that. All right, and that's absolutely just a value-added service, no cost, no charge for that. Assuming, worst case scenario, and you don't get approved for your modification, and then you move into one of the next steps, which is deed in lieu, or which are deed in lieu and a short sale. Well, from a short sale perspective, is we charge nothing from the homeowner. Is the bank ends up paying our commission when we list your home, and if we are able to successfully make you avoid a foreclosure sale and avoid a foreclosure on your record. So if we're able to accomplish that, and only if we're able to, do we earn our commission, and it's paid from the bank, not even from the homeowner.
Okay, someone has further questions, something that wasn't quite clear to them, or they're in the loan mod process now and they just want to talk to someone. One of us will go out there, someone from the ERA team will go out there, and they can put their checkbook away, right?
Absolutely.
Okay, you know what? Here's another question I see here. And this one's it looks like it's a good one for you, Kevin. There's a husband and wife. The husband's the only one on the mortgage, although the wife is on title. So how does a loan modification affect them?
The loan modification process, the moment that one party who took the original loan, so let's say in a scenario like this, they may have not been married at the time, it was a second residence, whatever. So in California, it's a community property state. So if you are married, whether your spouse is on title or not, it is inferred in the state of California that the debts are both of yours. So the loan modification process will take into consideration both incomes if you are married and it is your primary residence. Now, because the wife is on title as well. Now, if he had taken title, a married man as his sole and separate, and the loan matched up with that, then it would be his sole responsibility and his sole numbers that would affect the loan modification. Does that make sense?
That makes total sense, and I hope that answers the question entirely. You know what? We're about past the time. You know what? If you have any other questions or answers that we didn't get a chance to get to at this time, here's the number where you contact us. ERA by America. We're in La Palma. We're in Center Point, right at Orangethorpe in Valley View. Our phone number is 877-700-2880. And when calling in, you can ask for Dennis or Chase here, or just refer to the fact that you saw the webinar and you need some other questions answered. If you want to stop in, we're at 30 Center Point Drive, right across the street from Marie Callender's in La Palma. So I hope to hear from...
And if anybody has specific questions on investing, those types of things, I can be reached through the exact same numbers. They'll just patch you right through to me.
You know what? Thank you, Kevin, for doing that. I almost left you out. I had to cut Mr. Kelly. Cut Mr. Kelly off there. Okay, so all right. You know what, Chase? Thank you very much for sitting in on this. And Kevin Kelly with Chicago Title. My name is Dennis J. Lopez Sr., broker associate with ERA by America. Everybody that sat in on the webinar, thank you very much. And if you're seeing this on the web after the fact, thanks for taking the time to take a look at us. Give us a call when you get a chance. Thank you very much. Hey. Bye, guys.
Bye. Thank you.